let's start with
Thank
where,
you.
where we are right now and how we got here. Clearly, the Fed members are being polled in different ways right now, and there is dissension among the Fed board. Is this enough, or should this rate cut have come sooner?
No, I think this is consistent with the data dependence of the Fed. The data has been indicating that the labor market is slowing the gains of payroll employment. As a matter of fact, in today's press conference, Fed Chair Powell said he was concerned that there may actually be net job losses once all the revisions occur. So I think this is on target with the data. It's consistent with that. I also think that it's not at all clear that the lowering of interest rates is going to do much to help the labor market, because some of it has to do with the restriction on immigration, the deportations, impacting the supply, and some of that has to do with artificial intelligence, where companies are assessing whether artificial intelligence can be a productivity booster. So lower interest rates may just give us more demand and more productivity, which is all right. But it can also give us a speculative bubble in the stock market.
Well, we don't want that. Let's talk a bit about
No.
if it's not going to help the labor market, or if there are concerns that it won't. What does this decision mean for the average consumer?
Right. Well, I think that borrowing rates maybe on consumer loans might go down, but I don't think the credit card rates are going to go down. So if you're delinquent and you have a balance in your consumer credit card, I don't think it's going to have much impact there. I think that with regards to the mortgage market, we really haven't seen the bond yield, the 10-year bond yield, fall much in reaction to the 75 basis points in cuts in the Fed funds rate so far this year. So mortgage rates are still relatively prohibitive for a lot of people who are waiting for rates to come down.
And, the Fed also announced that it is going to resume buying Treasury securities.
Yeah.
Tell us the significance of this move and your thoughts.
I don't think it's very significant. As a matter of fact, the chair went out of his way to indicate that it was really more a technical than a fundamental move, that this was not an intention to impact monetary policy, but rather there's a market in the federal funds, the funds that are used as reserves by banks. They do trade them in this market, and sometimes there can be a liquidity problem that pushes interest rates up in a way that the Fed doesn't really want to see happen. And so the Fed comes in and provides that liquidity. That's all there is to it. I don't see this as the beginning of quantitative easing. What are we on now? 3 or 4. And I think the basic message is the Fed cut rates, and it's probably done for a while. It's in a good position to assess how the 175 basis point cuts in September of last year is impacting the economy.
Okay, you say the Fed could be done for a while. Okay, let's talk about the elephant in the room. President Trump treading on ground where other presidents have avoided, politicizing what is supposed to be an independent entity and tossing around his name calling and the insults, which sadly people seem to just accept at this point. Is this doing damage to the Fed, its reputation, and what about the international respect for the organization?
Well, I think the big issue that you're getting at is, of course, the independence of the Fed. And I think in some ways, in a perverse way, the Fed might actually become more independent in the coming year, because once there's a new Fed chair, and presumably that new Fed chair will be a Trump loyalist, it's very possible that other members of the Federal Open Market Committee will be more vocal in dissenting, not just at the actual vote, but also in their speeches. So we could have a Fed that's much less interested in consensus and more focused on disagreements. And so it's conceivable that the new Fed chair might want to lower interest rates more aggressively, but he'll turn out to be in the minority.
Yeah, I think a lot of people are I don't want to say fearful, but obviously concerned that Trump is going to appoint a yes man. And that individual, yes person, is going to take what Trump wants done and basically try to force it down the throats of all the other governors. If that happens, what do you see I'm sorry, go ahead.
Well, if that happens, and my friends, the bond vigilantes, will will react. Bond yields will go up pretty significantly. We see that situation, for example, right now in Japan, where bond yields have gone up quite a bit because the Bank of Japan doesn't want to lower interest rates. They're actually thinking about raising rates at the same time that the government wants to stimulate the economy. So it's a very similar situation. So beware of what you wish for. If Trump gets somebody in there that's a total, team player as far as he's concerned, I think there's going to be a lot of dissenters. I don't think they're going to get his way. But like you said, if they manage to push it through, the bond market will react violently,
Right.
and perversely, yields will go up.
We only have about 30 seconds, Edward. I want to ask you, you talked about earlier about credit cards, and we've heard a lot about the buy now, pay later. Do you think that could
Yeah.
be some kind of hidden explosive, if you will, in the economy that could really haunt us?
Yeah. Yeah, it's really not that hidden, and we're all aware of it. We're all concerned about it. It's not a good way to run an economy, and stimulate consumer spending. So it could be a problem down the road, for sure.